All right, all right. All right. See what we got here. What's going on, everybody? What's happening? What's going on? Feel me? Rise and grind. Now, I am a little tardy, but I didn't bust a move, so I'm on time still. I ain't bust a move, but yesterday I told y'all that we took profit on our AMD play because it was running up against resistance here. And that's why it's important to know your levels. Got to know where it's going. All right. Only way to know where it's going or direction it wants to go is to draw your levels. Draw your levels. We also know that when something goes outside of the Bollinger Bands, like as you can see here, when it goes outside either at the top or at the bottom, it has to come back in. So it was extreme and it had to come back in. On top of that, it was coming up against a resistance level. So we just add stuff together. Once we know what we're looking at, and you see it over and over and over again, you're going to be able to look at a chart and tell what's going on. It's like I'm sitting here doing it for you. You're going to be able to do this. So you put all these elements together. First, you got your levels, and you have your Bollinger Bands, right? So it's like, okay, is it extreme on the Bollinger Bands? Is it approaching a resistance? Right? Adding these things together. What is the MACD doing? Is it a new high? Right? Because what we're looking at is a momentum divergence. And y'all know that's my bread and butter. We're looking at a momentum divergence. So one should be waiting for this to stop falling somewhere. Right? We know it had to come in for the Bollinger Bands. Now we need to know where it's going to stop. But if you don't have any levels, you won't have any reference points. So you need to draw your levels. So as I drop down into my trading time frame, the hourly, look what we have here. So it's sitting on a level. Sitting on a level. So on the trading time frame, the MACD is the signal line is turned down. When the signal line is turned down, that's a recipe for puts. So on this trading time frame, of course, it looks different than the hourly. That's why you need to have this in your head. And this is why this has to be a routine, and then it'll be a habit for you to go from the daily to the hourly, or whatever your trading time frame is. Mine is the hourly. You have to pick one. I recommend you guys to, if you haven't already, download the free options trading checklist that is in the description of this channel. In the link in the description. Get that, because it's going to break down each one of these steps that I'm telling you. But you'll be able to have it to look at in order to run through the steps. But we're in this. I got a 10-day contract. Now, yesterday I was telling y'all that I could have waited. I could have waited a little bit for this entry, because I seen that it was extreme. I got in on a pullback, but I could have waited for it to pull back some more. Like today. But if I still believe that it's going to do what I believe it's going to do, I can average in. Meaning, like I was explaining yesterday, that excuse me, that if I wanted to buy a call, right? We know that options contracts increase with call contracts when the price of the stock goes up. When I'm in a call and the price goes down, the price of the stock goes down, what do you think happens to the price of the options contract? They get cheaper, right? If you're in a call contract and the price of the stock goes down, that means it's going against you. So that means the options contract loses value or becomes cheaper if you wanted to buy another one. It's going to be cheaper than you bought it because the price came down. So if the price comes down on the contracts, that means you can get another one for cheaper, if you still believe that it's going to do what it's going to do. So now the one you bought previously plus the one you bought now for cheaper, add them together, divided by 2. Now your average price of those 2 contracts is cheaper because you bought one for this price and one for this price. Add them together, divide them by 2. Those 2 contracts together are cheaper than the one you bought. That's why they call it averaging in. So I can average in because the first contract I bought was $300. Now they're $95. So now I will have 2 contracts. If I buy one now, 2 contracts will be worth $400. So that means I bought both of them for $200 instead of $310. That's why they call it averaging in. So then now when it goes back in my direction, I can sell one once it reaches back to 200 from 95. All right. Taking some risk off the table, leaving that one still. But now I only paid 200 for it, remember, because I averaged in instead of 310. So sell one once it reaches 200, keep the one, right? And let that ride, because that's what I bought initially anyway, one. You always want to take risk off the table. So I can average in. I should average in because I still believe that it's going to do what it's going to do. Matter of fact, that's exactly what I'm about to do. I'm about to buy another one for cheaper. Because I do believe it's going to do what it's going to do. I do. So boom, I just bought another one. So now I have two contracts. And I averaged in. So instead of paying $3.10 for them, now they're worth $2.06 a piece. So now I'm waiting for this to go back in the direction I wanted to go in. See what I'm looking at? So it's sitting on this support level here. It could possibly go down some more, or it could just consolidate right here. I believe it's going to consolidate right here because remember from previous videos that the older time frame, which is the daily is older or has a longer viewpoint than the hourly time frame. So the older time frame holds precedent. Right. So if the older time frame holds precedent and it's the daily, and the daily is showing a momentum divergence, that means anything below the daily, like the hourly, holds less weight than the daily. The hourly holds less weight because it's only the hourly. So whatever's going on in the hourly is going to be short-lived. It has to conform with the older time frame. So this is going down, but it's short. It's going to be short-lived because the daily says this is a momentum divergence. Now, is it going to do this 100% of the time? No. No, it is not. But this is it's a high probability of it happening because this is what happens when this happens. But the only way to know that is to be in the market and watching your charts. It's the only way it's going to become habit and second nature is if you're looking at this stuff on a daily basis. Yeah. So this is what we got with this. Let's see how we doing with QCOM. Once again, extreme on the Bollinger Band has to come back in. All right. Has to come back in. But what do we also see? A new high in the MACD and a corresponding red bar. Y'all know what that is. What is that? What is that, y'all? Let's say it together. Momentum divergence. That's what that is. So, how do we know when it's going to stop? Go to your trading time frame. It looks like it wants to stop here. That's where it looks like it wants to stop. But that's what it looks like to me. It looks like this is because it's a support level. Looks like this is where it wants to stop. And then continue. We are in this until October. October 20th. We're not keeping it to October 20th. Excuse me. So what is that? June, July, August, September, October. That is called a leap. 5-month contract is a leap. So we're going to be holding it for 2.5 months. And we have a 120 strike price. And it's already at, it was at 116. 113. So I'm giving it 2.5 months to go to 120. And they already started going in that direction because we are up 89% already since I called this out last week. We're up 88%. All right. So this is what we're looking for here. We're looking for this to stop. And where is it stopping? The 15-minute is the relatable time frame to the hourly to see what's going on in that hourly bar. So yeah, it looks like it wants to consolidate here. Yep. Back to the hourly. Yep. AMD. What's going on, AMD? See, look. What did I say? It looked like we wanted to stop right there, right? And what's the next bar? Green bar. Why? Because in the daily, what do we have? We have a momentum divergence. Folks are buying or looking to buy on the red bar when the MACD has a new high. Same thing, people are buying puts when the MACD is showing a new low and you see a green bar. You want to get in on the green bar for puts on that momentum divergence. But here we're looking for calls. So new high in the MACD with the corresponding red bar is a momentum divergence. We're looking for calls on this red bar. We're looking for calls on this red bar with the new high in the MACD. Calls on the red bar. Now there's no perfect entry. You can get it as good as you can get it, but perfect is never going to be an exact place to get in. Right now is pretty much a good place to get into because this is an edge. When I say trade your edge, whenever you see your edge meaning the high probability setup. This is a high probability setup. This is one of them. It's not extreme anymore on the MACD. I mean, on the Bollinger Bands. Came in, right? So that's a good sign. It came in. New high on the MACD. Red bar. That's our edge. Whether it's going to hold or not, that's out of our hands. But what we need to do is take our edge when we see it. But if it goes against us, we need to be able to weigh these parameters, whether we need to get out or average in. Right? I averaged in because it went against me, but I still see my edge. That's the only reason I averaged in, because I still see my edge. If my edge was gone, meaning if these red bars was here and this MACD was turning down, that is a bad sign. I would be getting out because the edge is gone. If you see your edge gone, don't try to hold on to the position hoping. Hope is not a strategy. Oh, I hope it turned back around. No, get out. Take the rest of your capital, live to trade another day. Live to trade another play. The edge is gone. Get your ass out because you regret it. Like, damn, I knew I should have got out. Yeah, take your capital, your remaining money that's in that play. Sell it for a loss. Loss is part of this. But if you trade your edge and your edge only, you will win more than you lose. And that is the key to the game. You're going to lose, but you're going to win more than you lose if you take your edge every time. You see it, take your play. That's how you do that. So hopefully this was insightful. This is the edge I see. I averaged in on my AMD 10-day contract joint. I still see my edge. I'm going for, well, the next level up is 125. But I have a 132, which I was shooting for this level. So what I'm going to do is, I already got it set up to sell one once it goes up a little bit. So taking some exposure off of the table. I bought another contract to average in, to bring the average price of my contracts down, because I bought them for 310. I bought one for 310. It moved against me to the point where they cost 95 now. So I bought another one, which brought my average price of the two contracts to 200 a piece instead of 310. So when it goes back up from 95, which it started already, and it goes to 206, one is going to be taken off the table. So now I'll have one that I paid $206 for, which means I'm closer to profit than I would have been if it was still worth 310. Hopefully that makes sense. So that's what we're doing. Let me give you a peek at quant data. If this is your first time tapping in, this is one of the tools I use, or this is the tool I use to track real-time options plays. What the big money is doing. Immediate puts. That. Nvidia puts. Expiring when? June 16th. That's a call. 420 call. So yeah, this shows you June 16th puts like that. Call, June 8th call, Nvidia call. Yeah, I still like my position. I still like it. But this is another set of eyes for me. Get a chance to see these are the people that move the market. So if you see some big money coming through in a certain play, you can take it to the chart and see what they see. Or try to see what they see. So we got an Apple whale alert, a 180 call that expires June 9th. So that's a week out. Basically, they're not holding that contract long. So let's look at Apple 180 call before we get out of here. They see an Apple 180 call. That's what they see. Let's see here. I can see that. MACD turning up. It's extreme on the it's extreme on the Bollinger Band. That's what they see. Horizontal line. Let me put this level here. Boom. So need this to come down. Yeah, I see what they see. Y'all see it? So on the hourly time frame, it broke a resistance. So now it's sitting on another. Let's draw this one too. So yeah, one. Yep. I can see it. I will wait for a red bar though to complete my momentum divergence. You just broke a resistance. See that? You just broke a resistance. So what we'll be looking for is a red bar. Yeah, see that? I want a red bar here. See them broke resistance. So I see what they see. I will wait for a red bar to get in and then take it to 180. They got a June 9th, so that means 10 days. They probably holding it for a couple days. But yeah, I see what they see. So that's how I use quant data. I see what the big money is doing, take it to the chart, and see if I can see what they see. Makes sense? So hopefully that got y'all right this morning. As far as why the average in, the thought process behind averaging in. If not, rewatch it. Ask me questions in the comments, and make sure y'all got your checklist of all these different things I just outlined. This stuff is on the checklist. Once you run through this stuff over and over and over again, you'll be able to look at the chart too and see what I see. It'll be like the Matrix. Shit done slow down so you'll be able to dodge the bullets like this here. Nah, dead ass. You look at this stuff over and over again, you'll be like Neo, for real. Stuff will slow down and become less confusing the more you do it. All right. So with that, make sure you get your checklist, and I'll see y'all tomorrow. Put your questions in the comments.